Tariff talks hit the markets once again. Stay tuned, we'll discuss this and much more. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget, click show more for additional information and links on today's video. Also, if you're looking for a different opinion, that of Wall Street and Big TV, please do consider subscribing. Year-to-date numbers, 615, what do we have? The two anchors, tech and small. Tech continues to drive higher, becoming very crowded right now. We'll talk about that in a second. But small caps, big surprise. Why? Tax cuts. Really benefit from the tax cuts. Number two, a rising dollar does not hurt the small cap companies as it does the S&P companies who derive 50% of their earnings from overseas. Let's go to the big charts. All right, so here's my clean S&P chart. Talked about this a couple weeks ago. We had this rising bearish wedge, and it looks like it was in fact working because we failed the other day. What did we fail? March 13th, our most recent highs. That's the top of the box. Could we break out of it? No, we did not. And of course, we're down pretty strong this morning because of tariff talk. So right now, a resolution's coming. You kind of see that wedge there? We're going to break out or break down one way or another. But despite that, short-term view is positive. Midterm view, here's our weekly chart. When you see that, we've broken through the 15-16 trend line, held it on Friday. But when we look at below some of my indicators, we still have some negative indicators on the weekly charts. We are pushing up a little bit. But despite that, we are still negative on the short term, more neutral than anything else. On our long-term view, we have our S&P monthly. As you would expect, we are still positive here. Looks very clean, nicely going up, a little bit of a cup forming there. We'll see if we can break out. Next up, market breadth. So here we've got companies above or below the 200-day moving average. And remember, above 60% is bullish and across the board, strong. Market breadth, 69% for S&P companies, 72% for NASDAQ, 68 and 75% for the small. So market breadth continues to look pretty good. How about a shorter term view? Those companies above or below their 50-day moving average. Well, again, pretty strong. 67 for the S&P, 83% for the NASDAQ, 70 for mids, and 79 on the smalls. So real strong, but we need to consider one thing. As of Friday's close, 70% of companies in the S&P have still not broken above their yearly high, this year's high. So we have to consider that as well. Also, don't forget for our Wealth and Wisdom viewers, we have a financial planning package, information below if you're interested. Let's go to the sectors. So the sectors, I have the top 5 sectors of the S&P. We've talked about tech, real strong. Financials, weak, really weak right now. Really because we've seen a pause on the treasuries, which we'll talk about. Healthcare looks pretty good, right? In line or actually just above where the S&P is. Consumer discretion, the 1%ers are spending their money, no doubt about it. High-end goods continue to get bought, and industrials still pretty weak. So pretty mixed view when you look at the overall sectors. Bringing it all together, U.S. equities. 11 of 11 style boxes are in an uptrend. So as a group, we are in an uptrend. International, only 10 of 53. That's up from 8, but still, as a group, very much down. So that is why we're also neutral right now on our signals. Next up, tweet of the week. Someone new here, Jonathan Tepper. As we've talked about, everyone is piled into the FANGs and tech stocks. Major push in there. Really getting a little bit concerned, getting very crowded in this space right now. We'll continue to watch that. Next up, Scott Minerd, great CEO of a major company, worth a follow. The world is standing on the brink of the great trade war. This is something only found in history books since the Great Depression. So this is definitely a concern, and we'll talk about that in a second. Treasuries, spreads, right? We talked about treasuries. One good thing is they have come down from their highs. Kind of expected that pullback. But look at the treasury spread. 10-year minus 2-year. Down to 0.38%. We started the year about 0.8. That is a big time drop here. 10 minus 2s, we really get concerned when we go inverted. So right now, we still have a little bit to go. But when you look at the trend, clearly it's not your friend. Next up on my radar. So following back up on semis, semiconductors, again, got in a couple weeks ago with some clients. Really nice, classic double bottom, started to break out again, was setting up, but pretty much looks like some other views here. We got to our recent high of 313 and failed. Now the good thing is we didn't come down with a gap down, just came down a little bit, and then we're starting to consolidate. So not concerned yet, not looking to get out of this. Just want to see what happens this week. Can we hold that consolidation and then possibly move to higher highs? I think momentum, if you look at that on the downside of the chart there, MACD, it is pointing down, so probably more consolidation before we see another break to the upside. Biotech, looking here again, same thing, classic double bottom, started to break out, not as strong as semis, but you see, kind of digging, grinding its way higher. So continue to like this trade here. We've broken out of a recent trend line, so hopefully we can see some higher numbers here. Next up, what keeps me awake at night? So, tariff talks. We've been talking about this. I want to remind you and go back to the past when we've had tariffs. So I think we go back as far as 1930, the Smoot-Hawley Tariff Act, and you see where it came in, where it became law, what happened to the markets, then they took it off, and then it went back up, okay? So tariffs are not good for the markets. When you look at our most recent, the Bush steel tariff, pretty much the same view, right? When they put it in place, market goes down, they withdraw it, market goes back up. Look, I am for fair trade. Tariffs don't work as you see by the past, but how do you get there? This is going to be a tough one and has a chance to continue to move the markets until we see some type of resolution. Next up, how expensive is the market? Real expensive. So the CAPE, cyclically adjusted price earnings. We're at 33.03. The median, the average over long term is 16. So we're at a double now, right? That is real expensive. What I've got here in the chart, you might want to pause and look at it. But basically, if we go to 20 on the CAPE, that would be a 20% loss. If we go to 15, which is fair value, that would be a 40% loss. And 10, which I don't see any reason for that to happen, would be a loss of 60. So again, we are way overpriced. Yeah, it's nice to see us go higher, but you know, when you get this expensive in the market, something's going to have to change. So wrapping things up, fear and greed. This week 61, week ago 63. So we're out of the neutral, little bit into the greed side, but it does show that clients, individuals are getting more into the market. So again, signals, short-term positive, mid-term neutral, long-term positive. Overall, things look good, but let's see what happens this week with tariff talks. Thanks so much for watching. Michael Loftus, Wealth and Wisdom TV.